When you're ready to buy or sell stocks, you have two main types of orders to choose from: market orders and limit orders. Each serves a different purpose, and understanding both is crucial for successful trading. Market orders prioritize speed, getting you in or out of a position immediately. Limit orders prioritize price control, ensuring you only trade at prices you're comfortable with. Let's explore how each one works and when to use them. A market order is an instruction to buy or sell a stock immediately at whatever the current market price is. Think of it like walking into a store and paying the price tag without negotiation. The key feature is speed. Your order gets executed right away during market hours. However, the trade-off is that you don't have control over the exact price. The final price you pay or receive might be slightly different from what you saw on your screen, especially in fast-moving markets. Market orders have four main characteristics you need to understand. First, they execute with incredible speed, filling almost instantly when the market is open. Second, there's price uncertainty because the final transaction price can differ from the quoted price you initially saw. Third, execution is virtually guaranteed as long as the market is open and the stock is trading. Fourth, they work best with liquid stocks, meaning highly traded stocks with lots of buyers and sellers, where price gaps are minimal. A limit order is an instruction to buy or sell a stock, but only at a specific price or better. When buying, you set the maximum price you're willing to pay. When selling, you set the minimum price you're willing to accept. It's like making an offer on a house. You specify your terms and wait to see if someone accepts. The major advantage is price certainty. You know exactly what price you'll get if the order fills. The downside is that your order might never execute if the stock price doesn't reach your specified level. Limit orders come with their own set of characteristics. First, you have complete price control. You decide the exact price you're willing to trade at. Second, execution is not guaranteed. Your order only fills if the market reaches your price. Third, you get price protection, preventing you from buying too high or selling too low in volatile conditions. Fourth, you can set time duration, choosing whether your order lasts just for the day or remains active until you cancel it, which is called good till canceled. Let's compare these two order types side by side. Market orders execute immediately, while limit orders may not execute at all. Market orders don't guarantee your price, while limit orders guarantee your price but not execution. Market orders are best when speed is your priority and you need to enter or exit a position right now. Limit orders are best when price control matters most and you're willing to wait for your target price. Understanding this trade-off between speed and control is fundamental to choosing the right order type. Knowing when to use each order type is critical. Use market orders when you need immediate execution and you're trading highly liquid stocks where the price won't move much between when you place the order and when it fills. They're ideal for getting into or out of positions quickly. Use limit orders when you want price control, especially with volatile stocks that have large price swings or with illiquid stocks that don't trade frequently. Limit orders protect you from overpaying or underselling in unpredictable market conditions. The key takeaway is that both order types serve different purposes in your trading strategy. Market orders give you speed, ensuring immediate execution when timing matters. Limit orders give you control, ensuring you only trade at acceptable prices. There's no universally better option. The right choice depends on your specific situation. Are you prioritizing getting the trade done now or getting it done at the right price? Understanding this distinction and choosing the appropriate tool for each situation will make you a more effective trader.
If you like this video, hit that like button and don't forget to subscribe. Visit codelucky.com for more such useful content.